Welcome back to Switzer on Sky News Money. Now, let's move on to a fund manager's perspective of our share market. Roger Montgomery has said that while he's cautiously optimistic on the share market, he is worried by stretched valuations in the USA and in Australia, and that it's increasingly hard to find high-quality businesses to invest in. So, does he see the move up to 6,000 hitting a wall? And what quality businesses is he currently investing in? Roger Montgomery, the Chairman and Chief Investment Officer of Montgomery Investment Management, joins me at the desk. Roger, welcome to the program.
Thanks, great to be with you again, Paul.
Let's start with the US, where perhaps, you know, we've seen a lot of movement. Wall Street keeps taking record prices, huge investment in the so-called FANGs. Have you got any concerns about valuations in the US?
Well, Robert Shiller came out with an interesting essay a few weeks ago, and he talked about his CAPE PE or CAPE ratio, the cyclically adjusted PE ratio that he developed, as being not very good at predicting crashes, but being very, very good, if not exceptional, at estimating future returns. When he looked at the current level, which is it's over 31.42 at the moment. Now, to put that into context, you have to go if you go all the way back to the late 1800s, you've only seen the CAPE Shiller PE ratio, or the CAPE ratio, this high once before.
Right.
And that was just before the tech wreck. So before the boom, on its way up to its ultimate peak, and then it subsequently crashed. Now, he makes the point that by itself, stretched valuations don't mean there's an imminent crash in the market coming. The more stretched those valuations are, however, if there is a subsequent correction, it makes the correction more toxic. The other observation that he makes is that quite a few analysts are saying, well, 31 isn't that bad because earnings are growing very strongly, in the order of 13% or thereabouts for the S&P 500. But he looked at 13 bear markets between 1871 and today, and he defined those bear markets as a 20% decline from a peak within a year, so within 12 months. And of those 13 periods, in all of them, of those 13 bear markets, in all of them, the earnings were growing strongly just prior. Right? The next thing that analysts bring up to say, well, we don't have to worry because, look, volatility is very low, so expectations of any kind of correction in the future are very low, and therefore we've got nothing to worry about. Well, in all but 2 of those 13 examples, volatility was also extremely low. And in fact, before the great crash of 1929, volatility was even lower than it is today. So all the conditions precedent for a correction in the past exist today, but we don't really have a catalyst. So back to your question, are valuations stretched? Yes, they are. Are FANG stocks stretched? Yes, they are, but not just FANG stocks. There's a lot of technology companies whose valuations are stretched, and it's because a lot of money is being focused on only a handful of stocks. I looked, for your benefit, I looked at, when I knew you were going to ask me this question, I looked at the NASDAQ 100, and I got down to E, the letter E, and I'd already found a dozen companies trading on PE ratios of more than 250 times. Some of those companies earn very little, and you can't put a PE on companies that earn nothing. And there's plenty of those. So you've got Netflix, for example, doesn't earn anything really. And at the peak...
We've got Amazon almost in the same category. There are some earnings there. But...
Yeah, I have to disagree with people who say that Amazon doesn't make any money, because it reports a profit of about $2 billion. And if you look at its cash flow, it generates about $16.5 billion. So it's actually earning plenty of money. It's just ploughing it back into the business. But then there are businesses, for example, you look at Tesla on a market cap of $61 billion. Look at Uber, you know, it's not listed, but it has a market valuation of circa $70 billion. And then you've got Twitter that doesn't make money. You know, and I think Zuckerberg...
But it has Donald Trump as its most biggest
well, he uses
followers,
it well,
right?
indeed.
That's right.
But you look at the combination of those three companies, they have a market cap combined of call it 140 billion US dollars, they don't make a profit. In fact, Tesla produced 76,000 cars last year on a market cap of $61 billion. Hyundai has a market cap of $34 billion, and it manufactured 3.2 million vehicles.
So we won't divide the market cap by cars, but you're right.
So there are stretched valuations or pockets of euphoria, but quite rightly, many observers also point out that we don't have the extreme broad-based euphoria that you see before recent corrections.
Let's bring it back to Australia. I mean, we talked about the US, where valuations are perhaps a little more stretched, but they've at least been able to demonstrate earnings growth. In Australia, we've got not valuations at the same level, but we're still struggling for earnings growth. Do you have any concerns about the Australian market?
Well, yeah, I don't look at the market broadly anyway. I'm not interested in the ASX 300's earnings growth, the consensus, the average number. I'm interested in individual businesses. But even here in Australia, we have some weird stuff going on. So, you know, there's a company called Updater, for example. Now, what Updater does is it provides an app that helps you move your electricity and gas bills across when you move house, amongst a few other things. It has a market capitalisation of $750 million. It's almost $1 billion. It's almost a unicorn. Yeah. You know, and then we've looked very closely at a business called Afterpay, which we think is an extraordinary business. It's got the potential, but it's trading now at 13 times NTA. It really has to generate very, very high levels of return on its book growth in order to justify that number. Now, it could double from here. That just means it's even sillier than it is today. So there's an absence.
So there are examples of perhaps not euphoria, but at least some.
Well, there's an absence of broad-based opportunities for growth and value, and so money's being focused on a few things, and when you get a lot of money focused on very few things, that's reflected in very high prices.
Okay, let's go to some stocks you like, what are some of the stocks you like? What are the high-quality businesses that you're currently investing in?
And I'm going to talk about it again tonight, but we've talked about REA in the past, Challenger. We haven't talked about Speedcast and Steadfast, both businesses that we think that we've done very well out of, mind you, particularly over the recent few months. Let's start with REA. Most people believe that REA's revenues are based on or driven by property prices. Well, nothing could be further from the truth. It's actually driven by the number of listings and how long they're listed for. Now, in a boom property market, you don't get a lot of listings. People sell, agents can sell your house, Paul, very quickly without even advertising it. But in a mature property market, such as we're starting to see the early signs of, then what happens is you get more vendors trying to get the price that their neighbour got a few weeks ago or a few months ago. You get more supply, so you get more ads. You get the buyers pulling back because they've got more choice, and when buyers pull back, it takes longer to sell. So your auction clearance rates start coming off. We're seeing that. And the inverse of auction clearance rates are time to sell on market is longer. So an ad on Domain or REA might be 30 to 45 days, and if it takes longer than that to sell the property, you've got to advertise again. Guess what? More ads. More competition to sell a property, so you're going to have more people paying the premier prices or the premium prices for the premier ad or the gold ad, for example, or the silver ad for Domain. And so that's going to be more revenue, so they move up the price point. There's more ads, and they have to advertise again, so they advertise for longer. So that's growth on growth on growth, and we're going to see better numbers coming out of REA.
And Challenger, obviously the tailwind with the annuities market, is some concerns about capital structure?
But I should say that no concerns for us about capital structure at all, but I should say with both Challenger and REA, they're both about fair value.
Right.
So now, that doesn't mean that in this market, fair value is actually pretty good, right? So in a market that's broadly expensive, to get quality at fair value is actually reasonable. It's actually a bargain, relatively speaking. So Challenger's main driver, and the thing that everyone should focus on, is the proportion of the $2 trillion currently in super that's going to move, and you know a lot about this, that's going to move from accumulation phase to pension phase. So currently that's about $50 billion or $48 billion a year. But in just 13 years' time, and anyone who's had children knows that that goes very quickly, in 13 years' time that will be $250 $50 billion a year. And we've seen legislation, the enshrinement this year of superannuation being for retirement income as opposed to what it used to be, which was for retirement benefit. And so more and more products, and the government's encouraging this through submissions by industry, what products will people need and want for retirement income, and annuities really are in pole position.
OK, well, we'll note down both Challenger and REA. Also note your caution that you say they are at value. Or
they're about fair value, which in this market's actually cheap.
OK,
yep.
But we'll note them down, and we'll come back in another time and talk about some of the other stocks you like.
OK, fantastic.
That's
Paul.
Roger Montgomery, the Chairman and Chief Investment Officer at Montgomery Investment Management. After the break, how do you build a business from the ground up? Well, our next guest did just that when she was only in her 20s. Tammy Barton, the founder of My Budget, joins the program.